You know those big economic headlines that fill your news feed? The ones that promise stability and growth, painting a picture of a robust, ever-expanding landscape. Well, what if those initial pronouncements, those very headlines we often take at face value, are actually masking a profound vulnerability, a kind of economic mirage? What if the underlying foundations we rely on for our economic understanding are far less solid than we're led to believe?
It's a compelling question, really, because we as a society are deeply reliant on those official metrics, the numbers that guide everything from, national policy to individual investment decisions. What a meticulous analysis of recent data, particularly from the Bureau of Labor Statistics, reveals is potentially a significant degradation in their reliability. This deep dive is about whether our economic foundation is far weaker than commonly perceived, and perhaps more critically, what that means for you, for your financial well-being, and, well, for your broader understanding of the world.
Exactly. We're plunging into a stack of insights that suggest we're navigating an unanchored economy, one where traditional markers are shifting, where the old rules of engagement seem to be in flux, and where a new playbook of central banking appears to be firmly in motion. We'll explore the evidence that points to this unmooring, delve into different perspectives presented in our sources, and ultimately consider what this evolving landscape truly demands of us, especially, when it comes to preserving wealth in an increasingly uncertain environment.
Our mission today is to truly grasp this profound shift, moving from an economic system we once believed was anchored in objective fundamentals to one increasingly defined by institutional interventions and, well, at times, what appears to be overt political influence. And in understanding this, we aim to highlight why assets like gold and Bitcoin are transitioning from being viewed as mere speculative instruments for the adventurous to essential strategic components for anyone seeking to navigate this new financial reality.
Okay, so let's begin with the very ground truth, the bedrock of our economic understanding, the data itself. And there's probably no better place to start than with the Bureau of Labor Statistics, or BLS, jobs report. It's widely regarded as one of the most critical monthly economic indicators, a true marquee event for markets. It's supposed to tell us the health of the labor market, right? But what if that crucial barometer itself is flawed?
That's really the core of the issue here.
Hmm.
The BLS jobs report is designed to give us insight into non-farm payrolls, unemployment rates, wage growth. You know the drill. Its monthly release sends immediate ripples through financial markets, influencing everything from stock prices to bond yields. However, what we're witnessing now is an alarming and frankly fundamental disconnect between the initial headline numbers, the ones that grab all the attention, and the final corrected data that quietly emerges later. It's kind of like seeing a blockbuster movie trailer that promises one narrative only for the actual film to deliver an entirely different plot.
And this isn't just a minor statistical anomaly we're talking about, is it? This sounds like a significant systemic issue in how these numbers are initially reported and, crucially, how they're subsequently revised.
Indeed. The BLS employs a multi-stage process. They first provide a preliminary estimate based on early survey responses, followed by a second and then a third estimate as more comprehensive data comes in. Beyond these monthly adjustments, they conduct periodic comprehensive benchmark revisions. Now, this is much deeper, more thorough reconciliation, where they compare their ongoing estimates to the more accurate near-census data from the quarterly census of employment and wages, or QCEW. It's really at this stage that the full picture, often significantly altered, truly comes into focus.
And this is precisely where the cracks of the foundation really start to show, isn't it? Our sources highlight that the most recent preliminary benchmark revision, covering April 2024 to March 2025, revised down the total number of jobs by a staggering 911,000 workers. That's nearly 1 million jobs just, erased from the official tally. For many critics, this isn't just a number. It's being cited as the biggest revision on record. And some are calling it, quote, another blunder in the lengthy history of inaccuracies and incompetence at the BLS. Strong words.
To truly grasp the magnitude of that 911,000 figure, just consider this. Over the last decade, the annual benchmark revisions have averaged an absolute change of only about 0.2% of total non-farm employment. This recent revision is far, far beyond that statistical norm. It's not a small tweak or a slight adjustment. It represents a fundamental rewrite of the story of our economic trajectory. It shifts the perceived narrative from one of robust, consistent growth to one of significant and underlying labor market weakness. The key takeaway here, I think, is that official economic statistics might no longer be just reporting the economy. They could be actively shaping a potentially false reality. This means relying solely on headline numbers is, well, maybe a recipe for being blindsided down the road.
Well, this level of statistical error Seems truly atypical. What does it actually mean for our understanding of the economy when, say, the initial jobs tally for June goes from a reported gain of 14,000 workers to a loss of 13,000 after revision? That's a swing of 27,000 jobs in just 1 month.
It's a huge swing.
And if you look at May and June combined, the economy initially appeared to add a robust 291,000 jobs. But after revisions, that number plummeted to just 33,000. That's a dramatic downward revision of 258,000 from the assumed growth. These aren't minor adjustments. They're wholesale changes to the picture.
Precisely. This kind of profound reversal in the sheer magnitude of statistical error is typically atypical. Usually, you only see this kind of thing outside of major economic turning points or during actual recessions. The research suggests these persistent errors can be attributed to several factors. First, you've got uneven response patterns from businesses participating in the surveys, where some sectors or company sizes might be more diligent in reporting, potentially skewing initial results. Second, potential staffing shortages within the BLS itself, which can impact the thoroughness and timeliness of data collection and processing. That's a practical issue. And third, increasingly, there seems to be a growing reliance on sophisticated modeling techniques rather than actual direct survey data. Now, modeling introduces its own set of assumptions and, frankly, potential for divergence from reality. This raises a crucial question for all of us. If the very foundation of economic data is shifting so dramatically, how can policymakers, businesses, and investors build anything stable upon it? How can they make genuinely informed decisions?
Yeah, like look at Table 1 in our source materials on the BLS revisions. May was initially reported as a gain of 139,000 jobs,
Right.
then revised down by a shocking 120,000 to just 19,000. June saw that downward revision of 27,000 we mentioned, turning a gain into a loss. Even July, which had a slight upward revision, still leaves a combined net revision of negative 21,000 for those 3 months after accounting for the initial benchmark revisions. It's just a pattern of constant downward reassessment.
It is. It's a consistent pattern.
This persistent downward revision brings us to a compelling analogy from our sources, one that really highlights a potential crisis of trust and confidence in official institutions. Imagine for a moment a private company CEO whose quarterly financial reports or, say, employee growth figures had to be restated with such dramatic revisions. Hundreds of thousands of workers, fundamental shifts in profitability. What would be the consequences in the private sector?
The user's analogy of a private company CEO facing such dramatic financial revisions isn't just rhetoric. It really underscores a critical and profound asymmetry in accountability. In the private sector, a chief executive officer who restated earnings or employee growth by such margins would face an immediate and severe crisis of confidence from shareholders. You'd expect lawsuits, probably a swift termination. The very act of such a massive restatement would be seen as a fundamental failure of management, internal controls, data integrity, the whole 9 yards.
Right, heads would roll.
Absolutely. The integrity of the Bureau of Labor Statistics data, by contrast, is the very foundation upon which policymakers, businesses, and investors make critical decisions. We're talking setting monetary policy, calibrating hiring strategies. When this foundation is revealed to be so unreliable, it undermines the entire evidence-based policy ecosystem, creating this ripple effect of uncertainty throughout the whole system.
So to put it simply, we've got a situation where the very data we use to gauge the economy's health is under serious question. This leads to a fascinating, if worrying, point about the erosion of trust and competence in our official institutions.
And this private sector analogy moves from hypothetical to, well, pretty concrete when you consider the recent firing of BLS Commissioner Erica McIntyre by the Trump administration. The administration justified this termination by directly citing these revised job numbers as the biggest miscalculations in over 50 years.
So applying a CEO analogy directly.
Seemingly, yes. But critics framed this action from an entirely different perspective. They viewed it as a politically motivated move, one that, quote, undermines the integrity of the federal statistical agency data ecosystem and risks turning the BLS into potentially a propaganda machine where data might be manipulated or presented to serve political narratives rather than objective truth.
So the debate isn't just about whether the data is accurate anymore. It's equally about the intent behind the data and the response to its inaccuracies. It's no longer a purely statistical discussion, but one steeped in political implications.
Exactly. When we connect this to the broader picture, the debate shifts. It's about the political intent behind the data and the reaction to its perceived failures. This suggests a systemic degradation of data as a reliable anchor for our economic understanding. When official sources are perceived as either incompetent or politicized, a dangerous void of reliable information is created. Our sources highlight that investors are already actively seeking alternative data sources, like the more real-time reports from ADP, to try and gain a clearer, maybe more reliable picture of the labor market. The fact that many market participants are, according to some reports, not even watching the BLS numbers anymore signifies a fundamental shift in how the economy is being perceived and managed. This erosion of a single, trustworthy source of truth introduces systemic risk. You have policymakers, businesses, investors all potentially operating on divergent, possibly flawed perceptions of reality. When everyone is working from a different script, how can any coherent economic play possibly succeed?
Okay, the cracks in our present data seem undeniable. But to really understand where we are now, it's helpful to examine how historical economic narratives were built and maybe sometimes misconstrued. Let's peel back another layer here by looking at a contentious historical debate. We often hear claims about the economy a new administration inherits. Our sources bring up a specific claim that President Trump, for instance, inherited a worse hand than originally thought. This narrative got a lot of airtime, but was it accurate?
Well, a thorough examination of the economic data and analysis from the period right before and during his inauguration provides a pretty direct contradiction to that claim. The research emphatically indicates that Trump inherited an economy in the midst of what was, at that time, the longest economic expansion in American history under the Obama administration. It was built upon a foundation of steady, accelerating growth. This was far from a fragile or failing economy. It was one that was not only stable, but seemed poised to continue its upward trajectory, having recovered for years.
So the numbers themselves tell a very clear story, showing a pretty robust economic picture at the time of that transition. What does this mean for the narrative versus the reality of that economic inheritance?
The data really does speak for itself. Let's just look at the specifics for 2017, the year of Trump's inauguration. U.S. real GDP grew by 2.3%. That's a notable acceleration from the 1.5% growth in 2016. The unemployment rate had been falling consistently since 2010, reaching a strong 4.4% by 2017, its lowest level since the year 2000. Civilian wages were also increasing steadily, up by 2.7%. Both consumer and producer price indexes were approaching the Fed's target of 2%, signaling healthy, modest inflation, not overheating. Business confidence, which had been near zero in 2016, saw a small but positive growth of 1.3%. And for investors, maybe most tellingly, the Dow Jones Industrial Average surged by a remarkable 21.7% in 2017. That's a huge jump from its 1.9% growth in 2016. The overwhelming body of evidence from multiple economic and governmental agencies at the time points to an economy that was on solid footing and already accelerating across key metrics.
So if the economy itself was objectively strong, what was the real worst hand dealt to the nation, as that narrative suggested? Because if it wasn't a failing economy, then the concern must have been rooted elsewhere.
That's the critical distinction the research makes. The deeper issue, according to this analysis, wasn't the state of the economy itself, but rather the trajectory of fiscal recklessness and debt that the incoming administration's proposed policies were projected to introduce. The Congressional Budget Office, the CBO, for example, forecast in April 2018 that under the new policies, annual federal budget deficits would total about $13.7 trillion over the 2018-2027 period. Now, this represented a staggering $4.3 trillion increase from the January 2017 baseline forecast made just before the administration took office.
Oh, okay.
So is this looming fiscal profligacy, this significant increase in national debt driven by policy choices rather than a weak inherited economy, that was arguably the actual worst hand dealt to the nation? It was, in essence, perhaps more of a self-inflicted wound or a chosen path than an inherited economic malaise.
And those new policies, particularly around trade and fiscal responsibility, they have their own significant impacts, right? Our sources characterize them as posing a recessionary threat. How did these specific policies actually play out in the economy, affecting different segments of the population?
Well, the policies pursued, particularly trade protectionism in the form of tariffs, had a complex and often contradictory impact. Tariffs, for instance, they were presented publicly as beneficial for American industry, a way to protect domestic jobs and strengthen manufacturing. However, the reality, as our sources point out, was far more nuanced and often detrimental. These tariffs effectively acted as a kind of stealth tax on consumers and businesses.
How so?
Well, consumers might not have seen a tariff line item on their grocery receipt, but they were paying more for everything from imported electronics to components used in domestically manufactured goods. Businesses importing steel or aluminum faced higher costs, which they then naturally passed on. What's more, corporations often use the spectacle of these tariffs as convenient cover to pad profit margins, according to the analysis, attributing price increases to external trade wars when, in reality, they were seizing an opportunity to increase their own earnings. This manipulation led to a clear rise in the producer price index, reflecting higher costs throughout the supply chain.
This sounds like it created what our sources vividly describe as a two-speed America. Or on one hand, you had affluent households and corporations continuing to buttress markets and see gains. But for most Americans, it meant facing economic stagnation and increased financial pressure.
Exactly. While the stock market was doing well, driven partly by corporate profits and this perception of a strong economy, for the average American, the experience was quite different. Wages were up a paltry 0.1% during one period cited, effectively meaning real incomes barely budged or even declined once you factor in inflation. Concurrently, we saw significant spikes in food bank demand across the country, clearly illustrating that the economic gains touted in headline numbers were not broadly distributed. This stark division meant a significant portion of the population was struggling with everyday costs, even as official narratives suggested overall economic health. It was a real disconnect between Main Street and Wall Street.
And beyond the direct economic impact of tariffs and spending, our sources also highlight actions that seem to undermine the very infrastructure of the economy and the public sector's ability to support growth.
That's a crucial point. Beyond the immediate economic levers, the policies also included actions potentially damaging to the long-term health of the labor force and the broader economy. For instance, there were moves to strip federal workers of collective bargaining rights, effectively weakening their ability to advocate for fair wages and conditions. Worker safety agencies saw their budgets and enforcement capabilities reportedly gutted, potentially leading to less safe workplaces. Furthermore, cuts in funding for critical public programs and a reduction in the federal workforce were seen by critics as undermining the public sector's essential ability to support private sector growth, things like regulatory oversight, research, development. A halt on large-scale infrastructure and clean energy projects also meant a significant reduction in economy-wide spending and job creation in those sectors. The culmination of these trade and fiscal policies, analysts argued, would likely lead to slower long-run growth, exacerbate existing inequalities, and contribute to a significant increase in national debt, building an underlying vulnerability even as some headline numbers appeared strong. It seemed, to some observers, like a strategy prioritizing short-term market optics over long-term economic resilience.
Okay, so we've discussed the reliability of economic data and the legacy of past economic policies. Now let's pivot to the Federal Reserve and its current leadership, specifically Chair Jerome Powell. Our sources bring up a pretty significant critique that he was late to raise rates in 2021. This seems like a foundational error, especially given the economic signals emerging back then.
This perception is indeed well-grounded in the post-pandemic period, as inflation began to surge to a 40-year high, ultimately hitting 6.6% in 2022. Powell and the Federal Reserve initially maintained that these price increases were merely transitory. Remember that.
Oh yeah, transitory was the word of the year.
Exactly. This stance, which essentially dismissed early inflationary signals, led critics to describe the Fed as being asleep at the switch, delaying crucial monetary tightening until March 2022. This delay, in retrospect, proved to be quite costly, forcing a much more aggressive sort of catch-up response later on.
Let's delve deeper into that. What exactly were the consequences of that delayed response? Because it seems like it forced the Fed into a much more aggressive, almost reactive posture later.
The consequences of that delayed response were indeed stark. It necessitated a sudden, aggressive series of interest rate hikes. It's quite remarkable to recall that after publicly stating a 75 basis point hike, that's a 3/4 percentage point increase, was off the table, Powell proceeded to deliver 4 such jumbo-sized hikes in a row right after his renomination was confirmed.
4 in a row.
Wow. 4. These were the largest single rate hikes since 1980. Creating what some called a 1-2 knockout punch for both fixed income securities and the broader bond market. In fact, the bond market experienced its worst 3.5-year run in at least a century. That led to immense pressure on financial institutions and investors reliant on stable fixed income returns.
What's particularly compelling here, though, is that the underlying cause wasn't just presented as a simple miscalculation on Powell's part. Our research points to a systemic issue, right? Embedded within the Fed's own intellectual framework, almost a fundamental blind spot.
Absolutely. The research clearly indicates that the issue stemmed from a systemic flaw within the Fed's intellectual framework, rather than just a misjudgment of the moment. Their 2020 framework, for instance, was specifically designed to address a different kind of economic crisis, namely, the persistent risk of deflation and the challenges of a prolonged period of near-zero interest rates. As one economist noted, the old framework almost didn't recognize that you could end up in a place where you could have very high inflation.
Huh. Yeah, interesting.
This created an asymmetrical policy approach that explicitly favored a strong job market over potential inflation concerns. In hindsight, this proved to be a critical flaw. It directly contributed to the delayed response to surging prices, and the ripple effects were profound. It led to a severe cost of living crisis for many Americans as prices outpaced wages. And systemically, it left the banking sector holding hundreds of billions of dollars in unrealized losses on their long-term assets as interest rates suddenly soared, impacting their balance sheets significantly.
Now that brings us to the second part of the critique, the flip side of the coin, if you will, that Powell now appears awkward and potentially late to cut rates. It seems the Fed is currently trapped between two very difficult positions, maybe of its own making.
The data from the labor market certainly supports this perception of an awkward predicament. Non-farm payroll employment, for example, has shown little meaningful change since April of this year. August added only a meager 22,000 jobs. That represents a notable deceleration from previous months' growth. By many measures, the labor market is coming to a standstill as businesses slow hiring dramatically. This pronounced slowing in job creation, coupled with increasingly apparent downside risks to employment, paints a clear picture of an economy that is cooling rapidly, perhaps heading for a recession.
So, okay, when you've got this pronounced slowing in job creation and downside risk to employment becoming increasingly apparent, why isn't the Fed cutting rates? Especially if, as you mentioned earlier, there are inherent lags in monetary policy, shouldn't they act preemptively? It feels like they're holding back even as the economy cools, defying conventional wisdom.
Despite this clear deceleration in the labor market and the growing economic headwinds, the Federal Reserve's monetary policy remains, by many accounts, far too restrictive. This is the essence of Powell's awkward position. On one hand, the slowing labor market and weak employment figures strongly suggest the need for rate cuts to prevent a deeper recession and avert unnecessary economic pain. Proponents argue that, given the normal 9 to 12-month lags in how monetary policy affects the economy, it is already past time to return rates to neutral or even below, to avoid overshooting and tightening too much for too long.
But there's clearly a complex counter-narrative at play here, isn't there? It's not just a straightforward decision to cut rates. What's holding them back, preventing them from using policy?
Precisely. The Fed faces a complex and precarious counter-narrative that makes cutting rates a highly risky decision. For instance, the reintroduction and persistence of tariffs have already begun to push up prices in certain categories of goods, notably imported consumer products and industrial components. While Fed officials might publicly describe this as merely a one-time adjustment, there's a very real and significant risk that these targeted price increases could become embedded in higher inflation expectations among consumers and businesses.
Ah, the expectations trap.
Exactly. If that happens, it could trigger a new, self-sustaining surge in inflation that the Fed would then have to combat all over again, potentially negating all their hard-won progress. It's a huge risk.
And this seemingly intractable dilemma seems to have forced a fundamental shift in their very framework, their guiding principles for monetary policy.
What's truly fascinating here is how the Fed's revised monetary framework, introduced in August 2025, tacitly acknowledges this predicament and maybe its own past missteps. The new framework notably abandons the word average in flexible average inflation targeting, or FAI. That was the framework that previously allowed the Fed to let inflation run higher for a time to compensate for past periods of low inflation.
Right, they jettisoned that.
They did. It also removes the term shortfalls when discussing employment goals. This isn't just bureaucratic jargon, it's a direct and significant response to the immense tension of their dual mandate, where, as our sources state, risks to inflation are tilted to the upside and risks to employment to the downside. They are grappling with conflicting signals, and their framework reflects a newfound caution and flexibility in addressing these simultaneous pressures.
So it's almost as if the central bank is no longer operating in a predictable, countercyclical manner, purely responding to economic cycles as it once did. It sounds like there's another powerful restrictive force at play, kind of tying their hands.
That's an astute observation. The central bank is indeed no longer operating in that straightforward, countercyclical manner. The research suggests the Fed is increasingly facing what's called financial dominance, a situation where it is essentially restricted and constrained by overriding concerns about financial stability. It simply cannot act aggressively to stimulate the economy, say, by cutting rates sharply, without risking havoc on the financial sector.
Because that sector got used to cheap money.
Precisely. This sector has, over years of prolonged low interest rates and quantitative easing, become addicted to cheap money and is extremely sensitive to sudden shifts in interest rates. The awkwardness of Powell, therefore, isn't necessarily a personal failing or indecision, but rather a reflection of systemic constraints and contradictions that have emerged directly from the Fed's previous policy choices. It's a precarious tightrope walk, where every step risks a fall not just into inflation or recession, but into widespread financial instability.
Okay, this brings us to a really profound question about the modern economy. Does the money printer, this idea of QE, actually prevent bear markets and maybe make recessions a relic of the past? It seems the central bank's playbook has indeed been perfected, but perhaps not in the way one might assume, especially when we talk about quantitative easing or QE.
That question is highly relevant because quantitative easing, QE, is a genuinely novel form of monetary policy. It really emerged into widespread use following the 2008 financial crisis. Its primary function is to stimulate economic activity when traditional policy tools, like lowering interest rates, are no longer effective because rates are already at or near zero. You hit the zero lower bound. It's essentially an unconventional tool deployed for unconventional times, designed to provide further monetary stimulus when the usual levers are exhausted.
Let's unpack this a bit further. How does QE actually work? What's the precise mechanism behind this money printer that allows the central bank to inject so much liquidity into the system and achieve its goals?
Well, the mechanism, while powerful, is relatively straightforward at its core. The central bank initiates large-scale purchases of government bonds and other financial assets, like mortgage-backed securities, directly from commercial banks. This action effectively injects new money directly into the banking system, which immediately increases bank reserves. Critically, these purchases also drive down long-term interest rates and asset yields across the board. This makes borrowing cheaper and the returns on safe assets less attractive. The ultimate goal, in theory, is to encourage lending and investment by making money cheaper and more abundant, thereby stimulating brighter economic growth and combating deflationary pressures. It's a powerful and unprecedented tool, but its effects are notoriously complex and far-reaching.
Right. And while the stated purpose of QE is often framed as stimulating the broader economy, our sources contend that its most undeniable effect has been squarely on financial markets. There seems to be a clear and positive correlation between a QE policy and a rising stock market. This is the money printer in action, seemingly propping up markets directly.
That's precisely right. The central bank's playbook, as described, works by manipulating price signals in three key ways. First, by lowering interest rates on inherently safe assets like government bonds, it makes holding cash or traditional fixed-income securities far less attractive for investors seeking returns. Second, by directly entering the market to buy up massive quantities of assets, it artificially creates higher demand for other asset classes, notably stocks. And third, by dramatically expanding the overall money supply, it fundamentally reduces the purchasing power each currency unit over time, encouraging people to move out of cash. These three mechanisms collectively create a powerful incentive, effectively pushing investors towards riskier assets in search of yield.
Okay, this is where it gets particularly interesting. If safe assets like money market accounts or government bonds offer minimal returns, where does that enormous flood of money it has to find a home, right? And it seems to be funneling directly into equities, inflating asset prices.
That's the core dynamic. When interest rates on safe assets plummet to near zero, investors are literally forced into relatively riskier investments to find stronger returns. This massive flood of capital into equities pushes up stock prices, often regardless of the underlying fundamentals of the companies themselves. It creates a market environment where, a rising tide lifts all boats, even those that might be leaky. This dynamic is further evidenced by a striking study mentioned in the sources, which found that the U.S. stock market has performed better than average only on days when GDP figures were released since quantitative easing was introduced back in 2008. This suggests that markets are no longer reacting as much to the lagging indicator of the real economy's health, but rather primarily to the prospect of further monetary stimulus and the removal of uncertainty that central bank intervention brings. The market has essentially learned to anticipate and profit from the Fed's actions.
So stepping back for a moment, it sounds like the central bank's primary function has shifted, almost imperceptibly perhaps, from managing the real economy, things like jobs, inflation, industrial output, to primarily supporting financial markets. Is that fair?
That's precisely the conclusion our sources draw. While the effect of QE on actual credit lending and the broader real economy remains difficult to quantify and has arguably had mixed results over the years, its effect on asset prices is profound and undeniable. The central bank has effectively created a system of what we called financial dominance, where it is restricted by an overriding need to ensure financial stability and prevent a catastrophic market crash. The money printer isn't primarily designed to prevent an economic contraction in the traditional sense by stimulating real growth. Rather, its core purpose now appears to be to ensure that any contraction doesn't lead to a sustained bear market or a severe liquidity crisis that could unravel the entire financial system.
That makes sense.
This then becomes the ultimate playbook for an unanchored economy. Maintain a high stock market at almost all costs, even as the underlying economic data weakens. This is enabled by the government's ability to monetize its own debt and the Fed's capacity to leverage a relatively small amount of Treasury capital into trillions in lending, effectively removing traditional constraints on fiscal and monetary policy. This has led to a situation where market capitalization is, some argue, too big compared to GDP, and equity markets have become addicted to artificially low interest rates, creating a highly sensitive and potentially fragile system.
It paints a picture of an economy that is perhaps more engineered than organic, driven by central bank actions rather than pure fundamentals. But even within this engineered landscape, there's a powerful new force emerging. While the broader economy shows signs of stagnation, a truly powerful new engine for corporate profitability and stock market growth has come to the fore. Artificial intelligence, AI.
It really is a game changer. AI is rapidly becoming an essential, often indispensable part of modern business strategy. It's not just a buzzword anymore. It's providing tangible tools that boost efficiency across almost every operational facet, dramatically reduce costs, and drive what appears to be genuinely sustainable growth in the corporate sector. This AI dividend is visibly transforming operations across almost every industry, fundamentally shifting how companies approach productivity and innovation.
So to give us a clearer picture, how is AI actually delivering this dividend? What are the concrete examples of how it's making companies more efficient and profitable, even when other parts of the wider economy might be struggling?
Well, AI is delivering this dividend by fundamentally shifting operations from reactive to proactive and by automating tasks previously done by humans or by less efficient systems. For example, in finance, AI improves financial planning accuracy, allowing companies to simulate incredibly complex financial scenarios with much greater precision and speed than ever before. It automates the creation of management reports, freeing up valuable human capital for more strategic analysis. In other sectors, consider manufacturing. AI enables predictive maintenance. That means equipment failures can be anticipated and prevented weeks in advance based on subtle sensor data, rather than just reacting after a breakdown. That saves millions in potential downtime and lost production.
Huge saves.
Huge. It optimizes energy use in factories by dynamically adjusting systems based on demand and external conditions, significantly reducing operational costs. And it dramatically improves logistics in complex global supply chains, leading to leaner, more efficient operations and faster delivery times. This isn't just automating basic tasks, it's intelligent, strategic optimization at scale.
Okay, but this is where it gets particularly interesting and perhaps a bit concerning for some. This newfound corporate efficiency, while boosting profits, has a direct and undeniable impact on the labor market. It sounds like a classic double-edged sword, creating immense value but also raising serious questions about job displacement.
Indeed. While broad economic forecasts suggest that AI adoption may have a modest and perhaps temporary effect on overall employment in the long run, it is already quite clearly and unequivocally displacing jobs in specific occupations, and this trend seems to be accelerating. Companies are discovering that they can become significantly more efficient and require fewer employees for the same or even greater output, which directly and powerfully expands their profit margins. This isn't just theory, it's actively happening now.
Are we seeing job losses directly attributable to AI right now? Is this already a reality for certain sectors or types of roles, or is it still something mostly on the horizon?
We absolutely are seeing it. A recent Harvard study, which analyzed data from 62 million workers, found a significant trend. After early 2023, firms that actively adopted generative AI cut junior employment by between 7% and 12%. And importantly, this wasn't necessarily through mass layoffs, which often grab headlines, but primarily driven by a slower rate of new hiring for these roles.
So replacing attrition, essentially.
Exactly. The study highlighted occupations at particular risk, including computer programmers, accountants, legal assistants, and customer service representatives. These are roles where AI can quickly take over repetitive, data-intensive, or analytical tasks, allowing companies to do more with significantly less human input. It fundamentally alters the demand for entry-level and even some mid-level positions in those fields.
What's truly fascinating here is how this corporate efficiency and reduced labor cost translate directly into market performance. This immense potential for enhanced profitability is clearly a major factor driving the stock market, particularly in the tech sector. Even as other parts of the broader economy might be stagnating, it creates a kind of selective boom.
Absolutely. We've already witnessed AI innovations fueling substantial and often unprecedented stock price gains for major technology companies. For example, NVIDIA, a leader in AI chips, became the first company to reach a staggering $4 trillion market capitalization back in July, followed shortly by Microsoft crossing that threshold too.
Incredible numbers.
They really are. This isn't just random growth. The elevated price-to-earnings ratios we see for these companies signal powerful investor optimism about their future profit and dividend growth. And that optimism is almost entirely tied to AI's perceived ability to dramatically improve productivity and, crucially, profitability. Beyond direct corporate operations, AI is also playing an increasingly significant role in the stock market itself. AI-powered trading robots, sophisticated portfolio managers utilizing machine learning, real-time analysis tools. These are now widely used by investors and institutions to identify market inefficiencies, predict trends, and execute trades at optimal prices, further influencing and often accelerating market dynamics. It's becoming a self-reinforcing cycle. AI drives profits, which drives stock prices, which then feeds into more AI investment.
Okay, so we've painted a comprehensive picture here. An economy characterized by unreliable official data, the politicization of crucial institutions, a monetary policy seemingly focused on engineering asset price inflation rather than true economic fundamentals, and this powerful new technological driver in AI that's creating massive corporate profits while simultaneously displacing some jobs. So what does this all mean for you, the listener, the investor, or just someone looking to protect their savings in this complex and, well, unanchored economic landscape? How do you escape this soft money trap, this environment where the purchasing power of your traditional currency is constantly being eroded by policy and inflation?
That's the critical question, isn't it? What's truly fascinating, or maybe concerning, is that in an economic environment defined by unreliable data, persistent political interference, and a monetary policy actively engineering asset price inflation, traditional portfolio allocation strategies may simply no longer be sufficient for genuine wealth preservation. We're talking about a fundamental paradigm shift in how we need to approach financial security. A new class of assets seems required, those not subject to the same inflationary pressures and central bank manipulation that inherently plague fiat currencies and traditional paper assets. This is the compelling evidence-based case, according to our sources, for a strategic shift toward what we call hard assets.
So just to be crystal clear for our listeners, what exactly is a hard asset? And why are they becoming so uniquely crucial in this particular environment, especially when traditional investments feel less reliable?
Okay, so a hard asset is fundamentally a tangible or physical item with intrinsic value. That means its worth comes from its inherent properties or utility, rather than simply being a claim on someone else's promise or debt. Think real estate, commodities, or, as we'll discuss in more detail, precious metals like gold. They are highly valued for their utility, rarity, and often emotional attractiveness, but critically, for their proven ability to hold value through various economic cycles. They provide a vital hedge against inflation and, crucially, offer what are known as non-correlated returns to traditional securities like stocks and bonds. That means their value doesn't typically move in lockstep with the broader market, providing a diversified and often stabilizing anchor in a portfolio, especially during turbulent times.
Right. So to connect this to the bigger picture we've been painting in a world characterized by dwindling trust in traditional financial systems and this idea of structural monetary debasement, where the value of currency is constantly being eroded by policy hard assets, really provide a tangible, resilient anchor for a portfolio. something you can literally or conceptually hold on to when everything else feels volatile and uncertain.
Exactly. They offer a counterbalance, a fundamental ballast against the uncertainty of a financially engineered world. And among these hard assets, gold really stands out with thousands of years of established history as a resolute store of value.
Oh.
It's far more than just a shiny rock. Its intrinsic value is derived from both its undeniable rarity and its significant industrial utility. It's critical in advanced electronics, scientific instruments, and of course, jewelry. Over extended periods, gold has consistently demonstrated its remarkable ability to act as an inflation hedge and has performed exceptionally well during periods of high inflation and economic instability, serving as a reliable store of wealth when fiat currencies falter.
Okay, but this is where it gets particularly interesting. With the global money supply expanding exponentially, you mentioned from under $1 trillion in 1970 to projected over $180 trillion in 2025. How does gold, with its inherently finite supply, possibly stand up against this torrent of new, ever-extending money? It seems like an almost impossible task.
This raises an incredibly important question about the nature of value in an inflationary era, doesn't it? In this context of unprecedented growth in global money supply, gold has remained the benchmark hard monetary asset. Its market capitalization, despite the vast expansion of fiat currency, continues to hold a historically significant share of the total global money supply. Its scarcity is its ultimate and immutable defense against the debasement of fiat money. You simply cannot print more gold. Its supply is limited by the physical constraints of mining and geology. That makes it a true constant against a sea of ever-expanding digitally created currency.
But the world is also increasingly digital, and that naturally brings us to Bitcoin. As a digitally native and decentralized asset, Bitcoin is emerging as a credible, albeit still somewhat nascent, alternative to gold for some investors. What's the core investment thesis here for Bitcoin, and how does it position itself in this landscape of hard assets?
The investment thesis for Bitcoin rests fundamentally on its provable scarcity, which is really its defining characteristic. It has a fixed and mathematically limited maximum supply of 21 million coins. No more can ever be created, period. This scarcity, which is enforced by a decentralized network of computers rather than by a central bank or any single government, is its primary and most powerful defense against the inflationary manipulation and debasement that plagues traditional, centrally controlled currencies. In essence, it aims to be a form of digital gold built on a foundation of mathematical certainty and cryptographic security rather than historical precedent or physical scarcity alone.
But how does Bitcoin truly compare to gold, with its thousands of years of established history, its physical utility, and its undeniable global acceptance? Bitcoin is still a relatively young asset, isn't it?
It absolutely is. Bitcoin certainly lacks the thousands of years of history and the industrial and jewelry utility that gold possesses. That's undeniable. However, its growth has been meteoric. Its market capitalization has grown from less than 0.1% of the total hard money basket. That's a conceptual combination of gold and Bitcoin back in 2015 to over 8% just a decade later. That's rapid adoption. Proponents argue that in an increasingly digital and interconnected world, Bitcoin can indeed serve as digital gold, a provably scarce, censorship-resistant asset that is potentially uncorrelated to traditional financial assets and can function as an asymmetric complement to gold. It's definitely a higher risk, higher reward proposition than gold, but one that offers a unique and potentially powerful hedge against the current financial landscape and the systemic risks we've discussed.
Okay, maybe we can quickly touch on that comparison table from the sources table too, just to highlight the key differences.
Sure. Looking at supply. Gold is mined. Its supply is variable based on effort, but ultimately finite geologically. Bitcoin is capped algorithmically at 21 million coins fixed, provably scarce. History. Gold has thousands of years. Bitcoin about 16 years, so its track record as an inflation hedge is still limited. Utility. Gold has clear industrial jewelry uses and central banks hold it. Bitcoin is primarily seen as a store of value or speculative asset right now, with limited use as an everyday exchange medium. Volatility. Gold is moderately volatile. Bitcoin is highly volatile, often acting like a risky tech stock. Correlation. Both are often cited as non-correlated with traditional assets. Gold has a long history supporting this. Bitcoin's evidence is shorter but growing, and ease of access. Both are pretty accessible now. Gold through physical, ETFs, futures, Bitcoin via exchanges, new spot ETFs, though self-custody adds complexity. They're distinct, yet potentially complementary tools.
Okay, so as we wrap up this deep dive, what does this all mean for you, the listener, as you navigate this complex and increasingly unanchored economic landscape? How do you synthesize all these insights into an actionable perspective?
What seems profoundly clear from the analysis is that the evidence strongly suggests our economy isn't as robust or stable as those headline figures might lead us to believe. The erosion of trust in official data, the institutional politicization of key economic indicators, and a monetary policy framework increasingly focused on financial dominance rather than pure economic fundamentals. These factors collectively demand a fundamental reevaluation of how we approach wealth and how we truly understand value in the 21st century.
So in this new paradigm, preserving wealth becomes maybe even more critical than simply chasing traditional growth, which, as we've seen, might be artificially inflated or selectively distributed anyway.
This raises an essential question for you, the listener. How will you position your portfolio in an economy seemingly unmoored from its traditional anchors? The analysis points towards a powerful, potentially complementary solution: gold and Bitcoin. Gold as the time-tested anchor, the conservative hedge with thousands of years of proven history, representing tangible, enduring value. And Bitcoin as perhaps a high-risk, high-reward, asymmetric bet on the future of money, a digital fortress designed to directly hedge against the seemingly endless expansion of global money supply and the systemic risks that come with it.
This has been a deep dive into an unanchored economy and the compelling case for hard assets. It leaves you with a lot to think about. How resilient is your financial strategy in a world where the very ground truth, the data we rely on, is constantly in question? What will you do to fortify your financial future and navigate this evolving landscape?